Imagine this for a moment. A single figure drops from a government report, and within a blink, just milliseconds, the quoted price of silver slides by nearly $1. What sets it off? The headline claims hiring is strong, yet half an hour later, silver suddenly surges, blasting past chart barriers. Why such a wild whipsaw? Because many trading machines react only to the bold headline, while investors who hold tangible assets dig into the fine print where the real story hides. For those quietly watching and realizing that modern data releases can shape emotions as much as reality, tune out the noise for a second. Close the distractions and focus. The labor statistics we're about to examine suggest we might be living inside a giant liquidity mirage. Before we dissect it piece by piece, ask yourself, where are you tracking the markets from? A big western city, or somewhere far away safeguarding physical wealth? Wherever you are, the key is understanding why silver often drops the instant upbeat job numbers hit the newswire. First, accept this. The price flashing on your screen isn't a pure read of supply and demand. It's often the result of automated rules firing on ultra-fast computers located close to major exchanges. When the monthly jobs report is released early in the morning, machines act before any person can read a sentence. High-speed systems can launch thousands of trades almost instantly. They aren't judging job quality or whether positions are temporary, part-time, or government-funded. They simply compare the headline to what analysts predicted. Their logic is mechanical. If hiring looks hotter than expected, the systems assume central bankers may keep rates elevated. In today's market mindset, good economic news can mean tighter money. Higher rates can lift the dollar, and since silver is priced in dollars, a rising dollar can trigger automatic silver selling. This chain reaction unfolds in milliseconds. It's more like a reflex than thoughtful analysis. But that first drop is just the surface. The deeper issue lies in how the data is built. The jobs total isn't a headcount of every worker. It's an estimate drawn from business surveys and household surveys. Then there's another layer many overlook, a model that estimates how many firms opened or closed. Because it's impossible to track every new or shuttered business in real time, statisticians use formulas to fill the gaps. Those formulas can add large job estimates that are, at best, educated guesses. When business failures are climbing, but the model still adds sizable job numbers, the headline can look stronger than the on-the-ground reality. That can create a fog around the true picture. The headline beats expectations, algorithms hit sell, and prices drop. Momentum traders notice the fall and jump in, pushing prices lower. It becomes a snowball effect driven by speed and psychology. Later on, quieter updates may revise those job counts. Sometimes prior gains are trimmed by large amounts. Numbers once celebrated can be scaled back after deeper review, but by then, the market has already reacted. Stop-loss orders may have fired, small investors may have been forced out. The market rarely rewinds to correct past reactions. Money has already changed hands, often from slower participants to bigger, faster players. That's the uncomfortable lesson. Fast markets move on first impressions, not careful audits. By the time fuller clarity arrives, the trade is long finished. This takes us to the most important part of the breakdown, bank involvement. You might wonder, if the numbers are unreliable and the sell-off is engineered, then who is on the other side buying? Who is picking up the silver that scared retail traders are dumping? The clue is in the commitment of traders report. A clear pattern shows up again and again. When a jobs report comes out and prices tumble, the commercial players, the group that includes giant bullion banks like JP Morgan and Citi, are usually closing out their short bets. They take advantage of the panic selling to repurchase contracts at cheaper prices. They are operating on a completely different level. They understand the data has flaws. They understand the physical supply is tight. They know solar manufacturers are projected to consume more silver this year than mines can supply. But they also know volatility around economic reports gives them chances to rebalance their positions. They allow algorithms to slam prices lower, scoop up liquidity, and then sit back for fundamentals to matter again. And that fundamental reality is returning faster than expected. This setup worked smoothly for many years, but now it is starting to break down. This is what many call the split between paper and physical markets. In the past, paper pricing led and physical prices followed. If futures dropped $1, coins and bars dropped too. That relationship is changing. When computer-driven selling hits paper prices after a questionable jobs number, physical premiums in places like Shanghai and Singapore often stay firm or even climb. The price gap between Western and Eastern markets is widening. Traders try to buy discounted futures in New York, take delivery, and flip it in Asia for profit. But they are running into resistance. Vault supplies are getting harder to move. Metal is not circulating the way paper volumes imply. That is a serious risk for anyone heavily short. Push prices too low and you actually encourage more physical buying. Cheap prices pull in demand. India increases imports, China adds to reserves. Solar companies build stockpiles. In trying to force a bearish narrative, large players may be speeding up the drawdown of the metal backing their own trades. What we are seeing is a system working against itself. Policymakers want strong employment data to support confidence in the dollar and bonds. Banks want big price swings to profit from. Meanwhile, the real-world supply of silver is tightening. Every attempt to knock prices down winds the spring tighter. The potential energy for a short squeeze keeps growing. A massive downward revision in jobs numbers is not just a tweak. It signals the economy may be weaker than reported. Pair a soft economy with stubborn inflation, and that mix has historically favored precious metals. Governments can create money and adjust statistics, but they cannot manufacture the silver needed for green energy projects. When markets finally call the bluff and digital pricing meets limited supply, the repricing may be sudden and sharp, not gradual. We could be watching the late stage of the paper-driven pricing game. Revisions are larger, premiums are rising, stress signals are becoming more visible. The biggest risk to silver's price today is not a group of speculators or a foreign rival. The pressure point may be coming from within the U.S. financial system itself. To see why silver might be building toward a big move, you have to look at the U.S. balance sheet. The country is in a debt cycle unlike anything seen before in modern finance. Federal debt is growing at a staggering pace, adding around $1 trillion in a short span of time. This is not emergency wartime spending. It reflects ongoing structural costs. The headline debt is only part of the problem. The real burden is the interest. Because rates have been held higher, the cost to carry that debt has surged. The government is now spending enormous sums just to cover interest payments. In a strange twist, interest expenses have rivaled or exceeded major budget categories. That creates a dangerous loop. To pay interest, more money must be borrowed. More borrowing means more bonds issued. To attract buyers, yields must stay appealing. Higher yields then raise future interest costs. It feeds on itself. This is where strain shows up in the banking sector. Many regional banks hold large amounts of bonds purchased when rates were near zero. With today's higher rates, those bonds are worth significantly less on paper. Losses remain unrealized unless sold, but if deposit withdrawals force sales, the losses become real. Recent bank failures showed how quickly stress can spread. Those events may have been early warnings rather than isolated cases. Hiding just below the surface is a massive problem in commercial real estate. Office buildings in cities like San Francisco, Chicago, and New York are sitting half empty, and many of them are funded by the same regional banks. Now those loans are reaching their due dates. The problem? These properties are often worth a fraction of what they were 5 years ago. Owners can't refinance because interest rates are much higher. That creates a huge solvency problem, and the Federal Reserve is fully aware of it. They're stuck in a tough spot. If they keep rates high to control inflation, they risk crushing banks and even putting pressure on the U.S. government. If they lower rates to rescue the banks, inflation could surge again and weaken the dollar. There really isn't an easy third option. So why is silver moving the way it is? Because silver stands apart from most financial assets. It doesn't rely on someone else's promise to pay. A government bond depends on politicians who may print money to repay debt. A bank account depends on a bank that could be over-leveraged. Stocks depend on markets fueled by easy money. Physical silver doesn't depend on any of that. It's a natural element. It doesn't need leadership teams, rescue plans, or even a stable government to exist as value. Wealthy investors and large private funds in the U.S. are quietly shifting money out of the traditional system. They aren't chasing quick profits in silver. They're using it as protection. They want to preserve what they have. They see where policy is likely heading. The government can't simply refuse to pay its debt. That would shake the entire global system overnight. So the more likely path is money creation. That means printing currency, controlling bond yields, and buying their own debt to keep rates down. Japan has already walked this road, and history shows many fiat currencies end the same way. When money printing ramps up again, all that new currency will pour into real, tangible assets. Real estate is already expensive. Gold is near record highs. Silver, though, still trades far below its historical peak from 1980. That makes it look like one of the cheapest forms of financial insurance available. The deeper issue is the long-term weakening inside the US dollar itself. Strong job reports can hide it for a while, but the structural deficit keeps growing. It's like damage spreading inside a building's frame. What we're seeing is a slow-burn debt problem in the world's main reserve currency. During debt crises, gold and silver stop behaving like simple commodities. They start acting like alternative money, forms of value that governments can't easily water down. Investors who watch bond markets understand this. That's why silver tends to recover even after price drops. It reflects concerns about long-term treasury stability. Now shift away from finance theory and look at the real, physical world. This is where supply and demand become unavoidable. You can create digital dollars instantly, but you can't create metal without mining, labor, and time. Years of low pricing have actually encouraged huge industrial use of silver. That has created a strange situation where demand is exploding while supply struggles to keep up. Consider the global push for clean energy. Many governments, from Europe to China to the US, have passed laws pushing renewable power. Solar energy sits at the center of that push, and solar panels rely heavily on silver. The industry used to rely on a technology called PERC. It worked fine, but recently manufacturers moved toward newer designs like TOPCon and HJT. These newer cells need significantly more silver, often 50 to 80% more per panel. So it's not just that we're building more solar panels. Each one now uses more silver than before. Solar has grown from a small consumer into a major force, using close to a third of global mine production every year. Unlike gold, which often gets stored, silver used in solar panels gets locked into equipment for decades. Once it's installed, it's effectively removed from circulation for 20 years or more. That's a one-way flow. And demand isn't flexible. Solar producers can't just swap in copper. Copper corrodes and loses performance. For high efficiency, silver is essential. Whether silver costs $30 or $300, manufacturers still need it. Otherwise, production lines shut down. And the pressure isn't only from energy. Defense and advanced technology sectors rely on silver too. It's the most electrically conductive metal known. It handles heat well. It resists corrosion. These properties make it critical in high-performance systems where reliability matters most. This is why silver is so important for missile guidance systems, for the microchips inside fighter aircraft, and for the satellites that keep GPS running. In a world where global tensions are rising, silver is more than a form of money. It's a strategic resource tied to national defense. That helps explain what's happening in the East. When China limits silver exports, it's not only about currency strategy. They're locking in supplies for their military and tech industries. They understand that in a real conflict, you can't build advanced weapons with digital coins. You need actual metal. You need silver. So where is all this silver coming from? That takes us to the real scene of the story, the big bullion warehouses. For many years, the New York and London exchanges acted like the world's silver reservoirs. They stored huge amounts of registered silver that was ready for delivery. Now look at the numbers. The registered supplies have fallen to levels not seen in decades. The vaults are being emptied. What we're witnessing looks like a bank run, but in the metals market. Big industrial buyers, major tech firms and solar manufacturers are stepping around the futures system. Instead of paper contracts, they're going straight to refiners and taking physical delivery. They're moving ahead of the exchanges. Why? Because they see the shrinking inventories. They know the old just-in-time supply model no longer works. They're switching to a just-in-case mindset. They're stockpiling. When a large solar company locks in millions of ounces for future production, that silver is effectively gone. It's not being flipped or resold. It disappears from the tradable pool. That tightens supply even more. Meanwhile, mining output isn't growing. In some major producing countries, output is actually slipping because of politics and lower quality ore. We're pulling less silver out of the ground while global demand keeps climbing fast. The numbers are harsh. For several years in a row, the world has used more silver than it mined. The difference has been covered by above-ground reserves, but those reserves are now running thin. On one side, the paper market, driven by trading programs and speculation, acts like silver is everywhere. On the other side, the real-world market, driven by manufacturing and defense needs, signals that silver is getting scarce. If those two worlds collide and the exchanges can't deliver enough metal for their contracts, prices won't just tick up. They could reprice dramatically. The cost may have to climb high enough to slow demand, maybe even forcing some industries to scale back. With government green energy pushes, that could mean prices far above current levels. The bottom line is straightforward. You can influence opinions and headlines, but you can't fake physical supply forever. Stocks are low, industry demand is strong, and miners can't easily boost output. This isn't just a quick trade idea, it's a potential supply crunch on a massive scale. So how might this end? Picture yourself at a poker table. The dealer, think of the central bank, is running the game, but suddenly admits some key cards are missing. The big chandelier overhead is rattling because the whole economy feels shaky. Meanwhile, a quiet player in the corner is steadily gathering chips, while others aren't paying attention. You've got two paths. One, you stay in your seat, trust the glowing numbers on a screen, and hope the system treats you kindly. Maybe it works, maybe it doesn't. Two, you step away calmly and trade those digital chips for something tangible, something solid, something you can actually hold, something that doesn't rely on electricity or printing presses. There are three possible outcomes. Scenario A, a gentle landing. Everything stabilizes. Even then, silver likely rises because demand stays strong and supply is tight. You still come out ahead. Scenario B, a hard crash. Markets fall apart. Silver could dip with everything else at first, then rebound sharply when confidence in paper assets fades. That's a big win. Scenario C, a full reset of the financial system. In that world, people holding real physical assets have the advantage. In the end, don't just take anyone's word for it. Don't rely only on TV or headlines. Pay attention to real-world supply and demand. Pay attention to what's tangible. When the party ends, and eventually it does, you don't want to be left holding scraps of paper while everyone else moved earlier. Stay safe.